For the first time in history, Bitcoin is no longer standing outside the financial system. It is slowly being pulled inside, not through hype, not through social media, but through something much bigger. Bitcoin ETFs. Most people think Bitcoin ETFs are just another investment product. They are not. They represent a structural shift in how money flows, how risk is managed, and how Bitcoin is perceived in the United States. And most retail investors still don't fully understand what that means. At first glance, a Bitcoin ETF looks simple. You buy it like a stock. You sell it like a stock. No wallets, no private keys, no exchanges. But beneath the surface, something far more important is happening. Bitcoin ETFs are changing who controls access to Bitcoin. For years, Bitcoin was driven by individuals, retail investors, early adopters, independent holders. Now, for the first time, institutions are entering at scale, not emotionally, but systematically. That changes everything. When institutions buy Bitcoin directly, price moves fast and violently. But ETFs don't behave like that. They accumulate quietly. They rebalance slowly. They respond to flows, not emotions. This is why Bitcoin's behavior around ETFs feels different, less explosive, more controlled, more mature. And for many investors, that feels confusing. Some people expected Bitcoin ETFs to send price straight up. Others feared they would destroy Bitcoin's purpose. The truth sits in between. Bitcoin ETFs do not kill Bitcoin, but they do reshape it. One of the biggest misunderstandings is thinking ETFs are bullish or bearish by default. They are neither. They are neutral infrastructure. ETFs don't care about ideology. They care about demand. If money flows in, they buy Bitcoin. If money flows out, they sell Bitcoin. No loyalty, no belief, just math. This creates a new reality for Bitcoin holders. Price movements are no longer driven only by retail excitement. They are influenced by retirement accounts, asset managers, and long-term allocation models. This is why Bitcoin volatility is changing shape. Still volatile, but different. Fewer random spikes, more structured moves, more consolidation phases. This frustrates short-term traders, but it attracts long-term capital. And that's the trade-off most people miss. Bitcoin ETFs are not designed for thrill seekers. They are designed for stability seekers. That does not mean Bitcoin becomes boring. It means Bitcoin becomes predictable in ways it never was before. For some, that is disappointing. For others, it is exactly what makes Bitcoin usable at scale. But here's the part that really matters. Bitcoin ETFs shift risk, not remove it. When people buy Bitcoin directly, they carry technical risk. Wallets, security, mistakes. When people buy ETFs, that risk moves to institutions. But market risk remains. If Bitcoin drops, ETFs drop. If Bitcoin rises, ETFs rise. The difference is psychological. ETFs make Bitcoin feel safer, more legitimate, more familiar. And familiarity brings capital. But it also brings expectations. Bitcoin is no longer just competing with other cryptocurrencies. It is now compared to gold, bonds, and equities. That comparison will shape how it is regulated, discussed, and integrated. This is why Bitcoin ETFs matter beyond price. They change Bitcoin's role from outsider asset to portfolio component, from rebellion to allocation. And that transition is not smooth. It creates tension between old Bitcoin believers and new institutional participants. One side values sovereignty. The other values exposure. Neither is wrong. But they are not the same. And this is where retail investors must be careful. Because the biggest mistake people make during structural shifts is assuming the old rules still apply. They don't. Bitcoin is not disappearing, but it is evolving. And those who fail to understand that evolution will either panic too early or get greedy too late. In Part 2, we'll answer the most important questions investors are asking right now. Are Bitcoin ETFs good or bad for long-term holders? How should retail investors think about Bitcoin differently now? What mistakes should be avoided at all costs? And what this means for Bitcoin's future beyond hype cycles. Because Bitcoin ETFs are not the end of the story. They are the beginning of a new chapter, whether people are ready for it or not. Bitcoin ETFs didn't just open a door. They changed how people behave once they walk through it. And behavior is what moves markets more than technology ever will. When Bitcoin lives inside a brokerage account, people treat it differently. They check it less often. They trade it less aggressively. They think about it in years, not weeks. This shift may look subtle, but it's powerful. Because the biggest enemy of Bitcoin returns has never been volatility. It has always been poor behavior. ETFs remove friction. And when friction is removed, participation increases. But participation without understanding is dangerous. One of the biggest risks in the Bitcoin ETF era is overconfidence. Because ETFs feel safe, investors allocate too much. They forget that Bitcoin is still a young, volatile asset. They forget that cycles still exist. ETFs do not cancel drawdowns. They make them easier to ignore until they're not. This is why disciplined position sizing matters more than ever. Bitcoin ETFs should not dominate a portfolio. They should complement it. Smart investors think in percentages, not emotions. Another mistake investors will make is confusing accessibility with endorsement. Just because Bitcoin is now packaged inside regulated products does not mean it is risk-free. Regulation does not eliminate volatility. It only organizes it. Bitcoin is still influenced by macroeconomic forces, interest rates, liquidity conditions, global risk sentiment. ETFs don't change those realities. They simply provide a cleaner on-ramp. For long-term investors, this creates an opportunity, but only if expectations are realistic. Bitcoin ETFs are not designed for constant trading. They are designed for exposure, and exposure works best when paired with patience. This is where the comparison to gold becomes relevant. Gold ETFs did not make gold exciting. They made it accessible. Over time, gold became boring but reliable. Bitcoin may follow a similar path, not identical, but familiar. More stability, less chaos, more institutional presence, less emotional whiplash. That transition won't happen overnight, and it won't be smooth, but it is already underway. Another important question investors must ask is whether they want exposure or ownership. ETFs offer exposure. Direct Bitcoin ownership offers control. For many Americans, exposure is enough. For others, control is the entire point. Problems arise when people assume ETFs give them both. They don't. This doesn't make ETFs bad. It makes them specific. And specific tools must be used intentionally. The investors who benefit most from Bitcoin ETFs are not the loudest believers. They are the quiet planners. They don't chase daily moves. They don't react to headlines. They don't confuse volatility with failure. They understand that Bitcoin's role is changing, and they adjust accordingly. This is the real impact of Bitcoin ETFs. Not price explosions, not overnight adoption, but behavioral change. Bitcoin is becoming something people hold, not something they constantly trade, and that shift matters more than most people realize, because markets reward consistency far more than conviction. In the years ahead, Bitcoin ETFs will continue to grow, not because everyone suddenly loves Bitcoin, but because portfolios evolve, diversification evolves, risk management evolves. Bitcoin ETFs fit into that evolution. The biggest mistake investors can make is assuming that ETFs guarantee success. They don't. They offer access. What you do with that access still determines the outcome. Bitcoin remains an asset that rewards patience and punishes impatience. That truth has not changed. What has changed is the environment around it. And in that environment, the winners won't be the ones who predicted the future perfectly. They will be the ones who positioned themselves thoughtfully and then stayed calm while the story unfolded. Bitcoin ETFs are not a finish line. They are a test of discipline, a test of understanding, a test of behavior. And like every market cycle before, the results will not be determined by headlines. They will be determined by how people respond when no one is watching.